So this morning, I want to quickly talk about some of the foundational concepts that we need when we start thinking about how we grow our wealth. Then go through some of the half-truths that we hear all the time from the financial experts, right? And so if you look at what most people do, if you are an employee, you're probably taking advantage of the plan that is offered by your employer, right? You're investing your funds. It may be in a retirement funds, or you may be doing that yourself. You may have your own RSP where you're investing, or you may have a financial advisor. And what the financial advisors typically do, sometimes they'll sit with you. If you've had that meeting, they'll sit with you, they'll draw up a plan, right? And that's what they call the financial plan. They'll draw up a financial plan and they'll make these projections that say, okay, if we invest, or if you invest certain amount of money every month and you invest for 20 years, they will build a plan that says, okay, for 20 years, after 20 years, your small investments that you're making every month, let's say is $1,000, $500 every month, will grow to say $1 million in 20 years, in 30 years. So that's a typical plan that they would draw out for you. But what happens most of the time? I mean, I've sit through some of those discussions, maybe 2 or 3 times over my career. But what typically happens once we sit through those transactions, or what are those assumptions that are based? What are the assumptions that they build those plans on? The first one is that they come up with a rate. I think they got maybe 5%, 6%. They come up with a growth rate. And they say, okay, let's invest. And they will assume that your money will grow for 6% each year, because according to them, that is the average return of the market. Right? And that's what we hear all the time. We hear this concept called average return. And I'm going to illustrate something to you now to show you why that concept is, there's nothing wrong with it. It's accurate based on the way it's calculated, but it's just half the truth, right? And so they build this plan based on that concept called average return. And they say, well, if you invest $1,000 every month for 20 years, for 30 years, after 30 years, you have $1 million. The problem is the market never goes up 6% every year for 20 years. That is the only way that projection will make sense. That projection will only make sense if the market goes up consistently 6% every year for 30 years. But if you know anything about the market, you know the market goes up one year, it goes down the second. It goes up again, it goes down the next year. So the market is always doing this. Now, if market is always doing this, you will never have 6%. But that calculation may be true. The average of 6% may actually be true. And I'm going to show that to you shortly. So that assumption makes no sense. So that is why the average employee, they buy this plan, they invest. And at the end of 20 years, they look at their statements, or they go to their investment advisor and they find that they are short $500,000, or they are short 300K or 400K. And then they cannot retire. Now they have to continue working. But again, they run into issues because now the employer won't even let them work anymore. They have to let them go. Then they'll end up going to Walmart or to work in a crazy job that they hate, just because they need to sustain their living, right? So that is the sad reality in today's market. But in addition to that, how many of you actually have this plan and have consistently invested the $1,000 or $500 that the plan suggested you invest every month, right? So most of us don't even do that, right? We may hit a bad month and we skip, right? So we skip 1 month, we skip 2 months. So what does that do to the plan? That messes up the plan, because that plan is based on compound interest, compound growth. So once you skip a month, once you skip a couple of months, it messes up that plan. So that's why that plan never works. That plan never makes sense. And how many of you, if you've done that plan, how many of you have actually picked up that plan, reviewed it maybe every year or maybe every 6 months to see, okay, when I made that projection or when I had that plan, I was supposed to be here at the end of 1 year. So how many of you have actually taken that plan at the end of 1 year? Then you look at your bank account or your investment account, compare it to the plan and see whether you actually achieved the results. Most people never do it, right? You never did. I never did it. In fact, I can't even find where those plans are. Because you do it and you never look at it, you forget it, you put it on the shelf. Right? And so that is a big problem with this industry. Right? It's a big problem with this industry. And that's why it never works. It never works. And so that's why I am an advocate for financial education, because I think if you know the truth, if you know what you need to do, then when you sit with your financial advisor or sit with your banker, you can have an intelligent conversation with them. Right? You can have an intelligent conversation with them. You can ask intelligent questions, and you can be part of that advisory team, right? Because now you know what you need to invest in, right? And so one of the reasons why we worry all the time is because we go to sleep, right? We go to sleep and we don't know where our money is invested in. And even most importantly, we don't even know why it is there, right? So part of the benefit of being in this group is, one, to know for yourself what you're doing, to know why you're investing, but more importantly, to know what you're investing in, but more importantly, to even know why you are investing in any of those instruments. So this is what typically happens, right? So for us to have financial success, we need dollars, we need resources, right? It's so important, we need resources. So right now, this is what the average employee does, right? So we take our resources, which we get from our employment, right? So we are working every day, we're trading hours for dollars. So we are working every day, we're accumulating, we're earning salary, we're getting money every 2 weeks. We're taking part of that funds and we're investing in a mutual fund or in a retirement plan, whatever it is. So we need resources. Without resources, there is no way you can build any financial plan, right? So it always starts with resources. So you need to have a job. If you don't have a job, you need to figure out a way to create income, right? Maybe run a side business. Maybe you have some high skills that you want to sell to someone that is willing to buy or pay you money for that. So you need to have the resources. So we take those resources, we invest it in the stock market, and we have something called the compound interest. So this is what allows the resources to grow through compound interest. We take our resources, we compound it, and over time, we'll build wealth. Right, so this is the typical plan. And there is nothing wrong with this plan, right? There is nothing wrong with this plan. So for us to build resources, we need to work. I can spell here, employee, right? So we need to work as an employee, right? So that's how we build resources. For the compound interest, most of the time they invest in the capital market, right? So this is where they invest the money. Capital market, mostly mutual funds. So most of the time we have our money invested in mutual funds and we get compound interest that way. So for do this, what you realize that is this takes a lot of time. So it may be 20 years, it may be 30, it may be 40, it may be 50 years, right? So it takes a lot of time for you to get that resources. Then at the end of the day, you're gonna be financially free. right? So that's the goal. So at the end of the day, you'll be financially free. So we take our resources, we'll compound it in mutual funds. We need a lot of time to build wealth, right? So that's the typical journey that we take as an employee, right? But what we need to do is to figure out a way to accelerate this plan. And if you've read my book, that is what that book is all about. How do you accelerate this plan? So instead of doing it in 20 years, 30 years, 40 years, or 50 years, how can you cut that time down and do it in 10, 15, 20 years? Right, so that is the whole idea of that plan. So we take the same concepts. We take the same concepts and we have to add something that I think is missing, right? And that thing is called the tax advantage, right? So which a lot of people don't offer you. So let me add something here. So I will insert. Okay, so we have to add something called tax advantage. Because if you realize, taxes is our biggest expense. Taxes is our biggest expense. So if you want to build wealth, you have to figure out a way to reduce your taxes, right? It's so important. Because if you're working as an employee, particularly if you're making over $100,000, right? You're paying 40, your marginal rate is almost 40% plus, right? And that is high. So that's why we got to look at our financial plan using a lens of taxes, so that way we are making smart decisions every time when we are building wealth. Because if you do that, you can cut time, right? So we're going to use all the other aspects of this. So we want to reduce time by employing tax advantage in the things we do. And we want to figure out a way to even have more resources or to create more resources, right? So we want to double this, sometimes triple it, right? And so you still keep your job if you have a job right now, because it's going to be foolish for you to abandon your job and go start something that you're not sure of, right? So you keep your job. If that's all you have right now, keep your job. Focus on how you can grow your gap, right? So focus on how you can grow your gap. So you want to increase your gap. And if you've been following what I've been teaching, so gap is when you make sure that your income is always higher than your cost of living, right? And so right now, if you have a positive gap, think of ways you can increase that so that you have extra income to build more resources. So focus on negotiate with your employees, see how you can increase your salary, get promoted, see if they can give you a raise, right? Focus on increasing your gap, and then look for a side hustle. Because a lot of you have a lot of skills, right? If you're working for an employer, you certainly have some skills, right? So you got to figure out, okay, what's one skill can you take and hone and say, okay, can I invest in myself a little bit and develop this skill so that I can now market this skill outside of my job and earn whether it's $500 every month, right? $300 every month, any additional income you can earn from that skill. And I think that's something we can all do. It's really not that hard. That's something we can all do. When I was working, I mean, for several years, I worked with PwC. As soon as I left PwC and started working with BMO, the first thing I did was to start a side hustle. I started doing tax returns for individuals. I started doing tax returns for some businesses, right? And 2 years into that business, I was making like extra $20,000. Just 3 years into that business. $20,000, and my expenses were, the margin was very high because my expenses were low. My expenses over a year to run that business was less than 5-6 grand with all the resources, the tools, the software, everything I had. Everything else was just my time, right? So it was the time I put in. My expenses was less than 5 grand. I was making $20,000. So that was an additional income. And that was not even taking me a lot of time, right? A lot of that time I do it in a span, all of that stuff, I do it in a span of 2-3 months, right? So in a span of 2-3 months, I will gross 20 grand. Right, so those were the good days, right? And I'm gonna share a lot of story about my business, how it has evolved. So you start a side hustle and you invest in yourself. Because this is how you develop your skill, right? So you invest in yourself to develop your skill, right? So if you have those skills, then you can earn additional income, right? So that is the idea. If you have those skills, you can earn additional income. Okay. So you have those, you have additional resources. We now compound those resources. But now, instead of using just the typical mutual fund that people use, in my book, I talked about how you can use your TFSA account, how you can use your RSP account. Again, still investing in those things, but rather than just blindly investing in mutual funds, come up with ways you can actually invest for yourself, right? And buy some high, good dividend stocks. Avoid some of those fees that mutual funds charge. Invest, maybe start with an index fund where the fees are a little bit lower. I talked about tax-exempt life insurance. Real estate for sure, and business. Right, so invest in tools that will give you the benefit of that compound interest. And of course, tax advantage, right? So tax advantage just means us using the lens of a tax smart investor or tax smart individual to make sure that everything we do it from that point of view, right? And all of these tools, right? If you're using these tools correctly, you automatically be employing tax advantage. And then if you do this, you will cut your time down to 10 years, 15 years, or maybe 20 years. You don't need 30 years, you don't need 40 years. And even that, with this, you will double, right? You will double, you will triple, 10 times the amount of wealth you can build. So this is the whole idea behind this, and this is what I'm hoping that you will get from our time together, right? And if you start planning like this, you'll see that you're going to be way ahead of everyone else. You're going to be way ahead of everyone else because you're going to be making the right decisions. You'll know why you're investing in something. You'll know why, you know exactly where your money is. You know why you're using these tools, because that's something we're going to be learning. You learn some of the tax advantages of these tools, and then you start investing, you start building knowledge, you start developing yourself, and before you know it, you'll start growing your dollars quickly, right? And so if you look at most of these investment funds, how do they earn money? They earn money based on a set fee on the money you have invested with them. So it doesn't matter whether you're making money or losing money. At the end of the day, they make the same amount of money, right? So they just want to earn a set fee, and that's why they want you invested in the market, right? They will do everything that they can to make sure that you're staying invested in their funds. You're staying invested in whatever they're recommending to you. So let me show you something quickly about, I talked about that briefly, about the compounding, this concept of average return. I'm going to share my screen here again. So this concept of average return. So for some of you, this is going to be absolutely shocking. It was for me when I started looking into this stuff. And so what I'm doing now, I'm going to share that with you because I have in 2000, I believe it was in 2012 or 2011, I have $50,000 I invested in mutual funds. I still have it today, but I'm going to liquidate it in the next week or two, right? And I'll tell you the reason why I invested in that. Because I mean, I knew this long ago that mutual funds, I know they charge a lot of fees. The only reason why I did that was leverage. So I went to BMO, then I was working at BMO, and they told me that they have this thing called an investment line of credit. Essentially what that meant is that they gave me a line of credit for $50,000, but the catch was, they said, okay, we're gonna give you a line of credit for $50,000. The only thing is though, is that you have to take that $50,000 and invest in BMO mutual funds, right? And so you see the trick there. For me, I looked at it because I'll tell you the reason why I did it. The reason why I did it was a couple of reasons. Then I was still growing my real estate portfolio. I always, when you're investing in real estate, they always need you to show proof of funds, right? So one of the reasons why I did that was that $50,000 invested in mutual funds will be one of the ways I show proof of funds for my down payment for buying real estate. And it served me for several years. I always use it every year. I've been using it up till the last investment that I made, which is about a year ago or 2 years ago, right? And so that's one reason I did it. The second reason was the tax advantage. Of course, I get to write off the interest. The third reason was that there was a fixed amount of money I get every month, right? So this was a fund that was paying out a certain amount of money every month. So it was generating income for me. So I had three things going for me. One, I could use the 50K as proof of payment to buy more real estate. Secondly, I could write off the interest for tax purposes. Thirdly, I was earning income every month. So it was good for me. I didn't see anywhere I could lose. The last time I checked, so it's been 8 years now, right? It's been 9 years now. Today we're in 2020. The last time I checked, that investment is still about 50 grand. So can you imagine? I've invested 50 grand. It's been 8 years. That 50 grand is still about 50 grand. It's probably less now. And as soon as I finish all the analysis, that's something I'll share with you. And it's going to make this thing I want to talk about now very, very important. So this is how we start with our investment. So you take $100,000. You take $100,000 and you invest in the stock market. So let's say you lose 50%. If you lose 60% of your money in the stock market, how much will you have left at the end of the year?
50,000.
That's right. So you have $50,000 left. Do you think it's possible for the market to go down 50% or close to that?
Of course, yes.
Yes.
It's happened. I think it's happened like two or three times already. I mean, you can Google it. You'll find that it's happened like 2 or 3 times. So the markets can go down 50%. And I'm sure it probably happened in the last couple of months due to COVID. The market can actually go down as much as 50%. So you start with $100,000, you lose 50%. At the end of the year, you end up with $50,000, right? So this is year one. So year two, you're starting with how much? $50,000?
50,000, yeah.
Let's say the market goes up 100%.
Go back to 100.
You're back to $100,000, right? So second year we had a good year. Is it possible for the market to go up 100%?
Not really.
I think it's possible. There is a possibility that the market can go 100%, but I don't think it's ever happened. right? I mean, you can check in Google, you can search it, but I don't think it has ever happened. I don't think the market has ever gone up 100% in 1 year, right? But now I'm just being conservative. So let's say the market goes up 100%, we are back to where we started. So let's do the average return. So what's the average return on this investment?
%6.
Well, I mean, the average return is how do you calculate average? You take those two numbers, you add it, and you divide by 2, right?
25.
So we take that, we take this.
50%.
That's right. So the average return, you take those two numbers, you add it, right? And you divide by 2.
Like 25.
So that would be 25%.
Yeah.
So that's how they calculate average return. You take those 2 years, those two numbers, you take the returns for all the different years, you add it, you divide it by the number of years. So in this case, we've had 2 years, and we've had 25% return. So when you look at your investment statement or talk to your broker, they will tell you that your average return that you've invested for 2 years is 25%. Is that true? That is true because it is mathematically correct.
Yeah.
Average return is 25%, but the principal is gone already.
So now let's talk about your real return. What is your real return?
Minus inflation.
So tell me, what is your real return?
0.
That would be rate of return minus inflation.
We're not even talking about inflation here. So I'm just talking about mainly looking at what you have. You started with $100,000.
Yeah.
Oh, I see what you mean.
$100,000. So your real return is 0 because you've not earned anything.
True.
That's true.
So this is the other part that we don't get to here. So this is what I'm going to ask you, your assignments. If you have money invested in any instrument, just put your statements. I mean, I'm going to do this exercise and I'll share my results with you based on that 50 grand that I told you about. What I encourage you to do, go pull your investment statements. Pull your investment statements, go back as many years as you can, and try to look at your statement, look at the real return or the average return, whatever return that the investment guys told you it is. Try and calculate your own actual return, your real return, and try to compare. So the investment industry, they're not lying to us when they tell us that our average return is 25%. But what they're not telling us is that our real return is 0%.